I have been the loudest voice on Wall Street telling everyday investors to buy index funds. I have said it in interviews. I have written it in my annual letters. I have bet $1 million on it and won. I have told my own wife to put 90% of her inheritance into a low-cost S&P 500 index fund when I am gone. And I still believe that for most people, most of the time, index funds are the single best investment vehicle ever created. But here is what keeps me up at night in late 2025. I am seeing warning signs that most index fund investors are completely ignoring. Warning signs that suggest the next decade could look radically different from the last one. And if you do not understand what I am about to share with you, you could be setting yourself up for years of disappointing returns, or worse, devastating losses that you simply cannot afford, especially if you are approaching retirement. Let me be absolutely clear about something before I go any further. I am not telling you to sell your index funds. I am not telling you to abandon passive investing. I am not trying to scare you into some complicated trading strategy or expensive actively managed fund. What I am telling you is that the index fund strategy that worked brilliantly for the past 15 years may not work the same way for the next 15 years. The conditions have changed. The risks have changed. And if you do not adapt your approach, you could find yourself wondering what went wrong while everyone around you is blaming the market when the real problem was a fundamental misunderstanding of what index funds actually are and what they are not. Let me take you back to 1999, because that year taught me something about index funds that most investors have never learned, and it is a lesson that is about to become relevant again. In 1999, index funds were the hottest investment on the planet. The S&P 500 had just delivered back-to-back years of 20% plus returns. People were quitting their jobs to day trade. Taxi drivers were giving stock tips. And everyone was piling into index funds because they had heard that Warren Buffett recommended them. The logic seemed bulletproof. Why pay some expensive fund manager to pick stocks when you can just buy the whole market for almost nothing? The data showed that most active managers underperform the index anyway. So just buy the index, hold forever, and get rich. Simple. Except it was not simple at all for the people who bought index funds in 1999. If you had invested $100,000 in an S&P 500 index fund at the peak in March of 2000, you would have watched that money shrink to about $55,000 by October of 2002, a 45% decline. And here's the part nobody talks about. It took until 2013, 13 years later, for you to get back to break even in real terms after adjusting for inflation. 13 years of waiting just to get back to where you started. A whole generation of investors who did exactly what I recommended, buy index funds and hold, ended up with nothing to show for over a decade of patience. Now, I know what you are thinking, Warren. That was a bubble. That was the dot-com crash. That was an exceptional circumstance. And you would be right, it was exceptional. But here's what concerns me deeply. When I look at the market today, I see conditions that are eerily similar to what I saw in 1999. Not identical, but similar enough that I feel obligated to warn you. Because the same people who lost a decade of their financial lives last time are the same type of people who could lose another decade this time. And they will lose it for the exact same reason, a fundamental misunderstanding of what index funds actually do. Let me explain something that most people get completely wrong about index funds. When you buy an S&P 500 index fund, you are not buying 500 stocks equally. You are buying a market cap weighted index, which means you are buying more of the biggest companies and less of the smaller ones. In practical terms, this means that right now the top 10 companies in the S&P 500 make up roughly 35% of the entire index. 35%, the top 10 out of 500. That is not diversification. That is concentration masquerading as diversification. And here is what makes this dangerous. Those top 10 companies we are talking about, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, Berkshire Hathaway, yes, my own company, and a couple others, these are all wonderful businesses. I own several of them myself. But they are trading at valuations that assume decades of perfect execution. They are priced for a future where everything goes right and nothing goes wrong. And in my 90 plus years of investing, I have never seen everything go right and nothing go wrong. Let me give you some numbers that should concern you. The S&P 500, as I speak to you, is trading at roughly 22 times forward earnings. The historical average is closer to 15 or 16 times. That means stocks are about 40% more expensive than their historical average. Now, expensive does not mean they will crash tomorrow. Markets can stay expensive for years. But expensive does mean that your expected returns going forward are lower, significantly lower. Here is the math that most index fund investors do not understand. If you buy stocks at 15 times earnings, and earnings grow at their historical average of about 6 to 7% per year, and the multiple stays the same, you will earn roughly 6 to 7% annually plus dividends. Call it 8 to 9% total. That is the long-term return of the stock market that everyone talks about. But if you buy stocks at 22 times earnings, and the multiple reverts even partially to its historical average over the next decade, that reversion alone will subtract 3 to 4 percentage points from your annual return. Instead of 8 to 9%, you might get 4 to 5%, maybe less. And that assumes earnings keep growing at historical rates, which is not guaranteed. We are in an environment of higher interest rates, potential trade wars, geopolitical instability, and a national debt that is approaching levels that historically have caused serious problems. Earnings growth could disappoint. If it does, and the multiple contracts at the same time, you could be looking at flat or even negative returns for an extended period, just like 2000 to 2013. Now let me address the first major reason why index funds could fail you in 2026 and beyond. I call it the concentration problem. As I mentioned, the top 10 stocks now represent about 35% of the S&P 500. But it is actually worse than that when you dig deeper. The top 3 stocks alone, Apple, Microsoft, and Nvidia, represent close to 20% of the index. When you buy an S&P 500 index fund thinking you are getting diversification across 500 companies, you are actually making a massive bet on just a handful of technology giants. Think about what this means if Apple stumbles, if Microsoft faces serious competition, if the AI boom that is driving Nvidia turns out to be overhyped. Your supposedly diversified index fund could get crushed, even if the other 490 companies do perfectly fine. This is not diversification. This is concentration risk hidden behind the illusion of diversification. And it is a relatively new phenomenon. Back in the 1970s and 1980s, the market was much more balanced. No single sector dominated like technology does today. When I was buying stocks in the 1960s and 70s, I could pick individual companies in various industries without worrying that my entire portfolio was secretly a tech fund. Today, even if you buy an S&P 500 index fund, you are essentially making a huge bet on technology continuing to dominate. That bet has worked spectacularly for the past 15 years. There is no guarantee it works for the next 15. Let me tell you about something called mean reversion. It is one of the most powerful forces in financial markets, and it is working against index fund investors right now. Mean reversion simply means that things that go up more than average tend to come back down toward average, and things that go down more than average tend to come back up toward average. It does not happen overnight. It does not happen on any predictable schedule, but over long periods, it is remarkably consistent. Technology stocks have dramatically outperformed the rest of the market for a decade and a half. At some point, that outperformance will reverse. The technology giants will either grow into their valuations slowly, delivering mediocre returns for years while earnings catch up to prices, or they will experience a sharp correction that brings valuations back in line quickly. Either way, the investors who pile into index funds today, expecting a repeat of the past 15 years, are likely to be disappointed. I have seen this movie before. In the 1960s, it was the Nifty 50. Everyone believed you could buy 50 great companies at any price and hold forever. Companies like Polaroid, Xerox, and Kodak were trading at 50, 60, 70 times earnings. They were wonderful businesses, but the prices were insane. When the reckoning came in the early 70s, many of these stocks fell 70, 80, even 90%, and some of them, like Polaroid and Kodak, never recovered. Ever. I am not saying Apple is Kodak. I am not saying Microsoft is Polaroid. These are genuinely great businesses with actual earnings and cash flows, but valuation matters. It always matters. And the valuations of the mega cap tech stocks that dominate today's indexes are high enough that even great businesses can deliver disappointing returns. The second major reason index funds could fail you is what I call the passive investing paradox. For decades, money has been flowing out of actively managed funds and into passive index funds. This makes perfect sense from an individual investor's perspective. Why pay higher fees for worse performance? But here's the paradox that nobody talks about. When too much money is invested passively, the market becomes less efficient, not more efficient. Let me explain what I mean. The traditional argument for index funds is that active managers cannot beat the market consistently because the market is efficient. All available information is already reflected in prices. So trying to pick winners is a waste of time and money. Just buy everything and accept the market return. This was a reasonable argument when passive investing was a small part of the market. Active managers were competing against each other, driving prices to fair value, and index fund investors could free ride on all that price discovery. But what happens when passive investing becomes the majority of the market? What happens when more money is flowing into index funds than into active strategies? Who is doing the price discovery then? The answer is fewer and fewer people are doing price discovery, which means prices are becoming less and less connected to fundamental value. Stocks get added to the index and automatically go up because index funds have to buy them regardless of whether the company is actually worth more. Stocks get removed from the index and automatically go down because index funds have to sell them regardless of whether the company is actually worth less. This creates a dangerous feedback loop. Money flows into index funds, which buy stocks regardless of price, which pushes prices up, which makes the index fund's performance look good, which attracts more money into index funds, which buys more stocks regardless of price. Do you see the problem? There is no analysis happening. There is no price discovery. There is just money mechanically flowing into the same stocks because they are in the index. At some point, this disconnect between price and value becomes too extreme. At some point, the bubble pops. And when it doesn't, the same mechanical forces that drove prices up will drive them down. Index funds will have to sell into a falling market because investors are redeeming. That selling will push prices lower, which will cause more investors to redeem, which will force more selling. It is the same feedback loop in reverse. I am not saying this will happen in 2026. I am not saying I know when the reckoning will come, but I am saying that the structure of the market today, with so much passive money, creates risks that did not exist 20 or 30 years ago, and those risks are not reflected in the simple advice to buy index funds and hold forever. The third reason index funds could fail you is interest rates. For most of the past 15 years, we have lived in a world of essentially free money. Interest rates were near zero. The Federal Reserve was pumping trillions of dollars into the financial system. Borrowing was cheap. Cash was trash. The only place to earn any return was in stocks. This environment was rocket fuel for equity prices, especially for the growth stocks that dominate today's indexes. Think about what happens when interest rates are near zero. Future earnings become incredibly valuable because there is no opportunity cost of waiting. $1 of earnings 10 years from now is worth almost as much as $1 of earnings today because you cannot earn anything meaningful on your cash. In the meantime, this justifies extremely high valuations for companies with growing earnings. It justifies paying 50, 60, 100 times earnings for a company that is expected to grow rapidly. But interest rates are not near zero anymore. They are at 5% or higher. and that changes everything. Now, $1 of earnings 10 years from now is worth significantly less than $1 today, because you can earn 5% risk-free just holding treasuries. This means those sky-high valuations that were justified in a zero-rate world are much harder to justify in a 5% rate world. The market is not fully adjusted to this new reality. Stock prices have remained elevated even as rates have risen. This is partly because investors are hoping the Fed will cut rates back to zero. They might be right, but they might also be wrong. If inflation proves stickier than expected, if the Fed keeps rates higher for longer, if we have entered a new regime of permanently higher interest rates, then stock valuations have significant room to fall. And that means index fund returns could disappoint for years. Let me share a historical example that illustrates this risk. From 1966 to 1982, a period of 16 years, the stock market went essentially nowhere in nominal terms. The Dow Jones Industrial Average started the period around 966 and ended around 966 16 years later. If you adjusted for inflation, which was rampant during that period, you lost about 75% of your purchasing power, 75%. And this was not because American businesses were failing. Earnings actually grew during this period. The problem was valuation. Stocks started the period expensive, and rates rose dramatically as inflation took hold. The combination of starting expensive and rising rates created a brutal environment for equity investors. I am not predicting a repeat of the 1960s and 70s. Inflation today is not nearly as high as it was then. But the lesson is clear. When you start with high valuations and rates are rising, you can have a very long period of disappointing returns, even if the underlying businesses are doing fine. Index fund investors who expect automatic 8 to 10% returns every year need to understand that those returns are not guaranteed. They depend on starting valuations and interest rate trends, both of which are unfavorable right now. The fourth reason index funds could fail you is what I call the geographic trap. When you buy an S&P 500 index fund, you are buying 500 American companies. That sounds diversified, right? But here is what you might not realize. You are betting everything on America continuing to dominate the global economy. You are betting that the trends that made American companies the most valuable in the world will continue indefinitely. Now I love America. I have bet my entire fortune on American businesses, and I still believe that America has enormous advantages that will persist for decades. Our innovation ecosystem, our rule of law, our capital markets, our entrepreneurial culture, these are real competitive advantages, but I have been around long enough to know that no advantage lasts forever. In the 1980s, everyone thought Japan would take over the world. Japanese companies were buying American real estate, American movie studios, American icons. The Nikkei index hit nearly 40,000. Experts were writing books about Japanese management superiority. If you had invested all your money in Japanese index funds at the peak in 1989, you would still be underwater today, 36 years later. The Nikkei never got back to its 1989 highs until just recently. I am not saying America is Japan. The situations are very different. But the lesson is that no country dominates forever. Empires rise and fall. Economic leadership shifts over time. And if you have 100% of your money in American index funds, you are betting against thousands of years of history that says dominance is temporary. China is growing despite its current challenges. India has over 1 billion people and a rapidly developing economy. Southeast Asia is booming. Africa has enormous long-term potential. Europe, for all its problems, still has many world-class companies. By focusing exclusively on American index funds, you are ignoring most of the world's population and most of the world's potential growth. Now let me talk about what concerns me most about index funds in 2026 specifically. The AI bubble. I say this as someone who believes artificial intelligence will be transformative. I say this as someone who has investments in companies that will benefit enormously from AI, but I have been investing long enough to recognize a bubble when I see one. And the mania around AI stocks today has all the hallmarks of a classic bubble. Companies with any connection to AI are seeing their stock prices surge. Nvidia has gone up tenfold in a couple of years. Other AI-related companies are being valued at levels that assume decades of massive growth. The story is compelling. AI will change everything. AI will create trillions of dollars in value. AI is the most important technology since the internet. Maybe all of that is true. Probably a lot of it is true. But even if AI is everything its proponents claim, that does not mean AI stocks are good investments at any price. Remember the internet in 1999. The internet was real. The internet did change everything. The internet did create trillions of dollars in value. But 90% of internet stocks went bankrupt or fell 90% from their peaks. The investors who bought internet index funds at the top of the bubble in 2000 had to wait over a decade to break even. They were right about the technology and wrong about the investment because they paid too much. I worry that the same thing is happening with AI. The technology is real, the potential is real, but the valuations assume that everything goes perfectly, that every company executes flawlessly, that competition does not emerge, that regulation does not interfere, that the technology advances continue at their current pace. When you pay 100 times earnings for a company, you need everything to go right. And in my experience, everything never goes right. Here is the connection to index funds, because AI stocks have gotten so expensive, and because they are weighted by market cap, AI companies now represent a massive chunk of the S&P 500. When you buy an S&P 500 index fund today, you are making a huge bet on the AI bubble continuing. If AI lives up to the hype and valuations stay elevated, you will do fine. But if AI disappoints even slightly, if there is any hiccup in the growth story, these stocks could fall dramatically, and they will drag your index fund down with them. Now, I want to be clear about what I am not saying. I am not saying you should sell all your index funds and try to pick stocks for most people. That would be a disaster. I am not saying you should try to time the market, getting out before the crash and getting back in at the bottom. That is impossible. I am not saying you should pay some expensive money manager to actively manage your portfolio. Most of them will underperform the index anyway. What I am saying is that you need to understand what you own when you own an index fund. You need to understand the risks, not just the historical returns. You need to have realistic expectations about what index funds can and cannot deliver in the current environment. And you need to think about whether your portfolio is appropriately positioned for a range of outcomes, not just the bullish scenario where the last 15 years repeat. Let me share what I would do if I were starting from scratch today with my life savings, knowing everything I know about markets and valuations and risks. First, I would still own index funds. They remain the best vehicle for most investors to access the stock market at low cost, but I would own them with realistic expectations. I would not assume I am going to earn 10% per year, like the historical average. I would plan for something more modest, maybe 5 or 6%. Given current valuations. Second, I would diversify beyond the S&P 500. I would have some allocation to international stocks, even though they have underperformed for years. Mean reversion applies to countries too. I would have some allocation to smaller companies which are trading at much more reasonable valuations than the mega caps that dominate the index. I would have some allocation to value stocks which have been left behind in the growth stock frenzy. Third, I would maintain significant cash reserves. I know cash feels like it is earning nothing meaningful, but 5% is not nothing. And more importantly, cash gives you options. When the market crashes, and it will crash at some point, cash allows you to buy at lower prices. The investors who did best after 2008 and after 2000 were the ones who had cash available to deploy when prices collapsed. Fourth, I would match my investments to my time horizon. If I needed money in the next 5 years, I would not have it in index funds. Period. The risk of a lost decade is real, and 5 years is not long enough to recover. If I had 20 or 30 years, I would be more aggressive, because time heals most investment wounds. But if I was approaching retirement, I would be much more conservative than most financial advisors recommend. Fifth, and this is perhaps most important, I would focus on my savings rate more than my investment returns. In the current environment where expected returns are lower, the most reliable way to build wealth is to save more, cut your expenses, increase your income, put more money away each month. No investment strategy can compensate for not saving enough, and higher savings can compensate for lower returns. Let me talk about what actually happens during lost decades, because I think most investors do not really understand what they would experience. In a lost decade, you watch your portfolio go down or sideways year after year. You see the headlines telling you the market is struggling. You hear the pundits debating whether this time is different. Your friends stop talking about their investments because there is nothing good to say. The psychological toll is enormous. Every month you contribute money to your index fund, and every month it seems to go nowhere or down. You start to doubt the whole strategy. You start to wonder if you should be doing something different. Maybe you should try trading. Maybe you should buy gold. Maybe you should just give up on the stock market entirely. These doubts eat away at you. They are exhausting. And eventually many people give in. They sell at the worst possible time, locking in losses, swearing off stocks forever, and missing the eventual recovery. This is the real danger of lost decades. It is not just the financial loss. It is the psychological damage that causes people to make terrible decisions. And the best way to protect yourself from this psychological damage is to understand the possibility in advance, to have realistic expectations, to be mentally prepared for an extended period of disappointing returns. I want to address something that the index fund industry does not like to talk about: survivorship bias. When they show you those long-term charts demonstrating that the stock market always goes up over time, they are showing you the American stock market, the one that happened to become the dominant global market. They are not showing you Japan, which is still below its 1989 highs. They are not showing you Germany, which got wiped out by hyperinflation and war. They are not showing you Russia, where investors lost everything in the revolution. They are not showing you China under Mao, or Cuba, or countless other markets that ceased to exist or destroyed investor capital. The assumption that stocks always go up over time is based on a sample of one country that happened to win the 20th century. It is not a universal law of finance. It is an observation about one particular market during one particular period of history that does not mean American stocks will not continue to perform well. I still believe they probably will. But it does mean that the guarantees implicit in the buy and hold forever philosophy are not actually guarantees at all. Let me bring this all together. Index funds are wonderful tools that have democratized investing and saved millions of people from expensive, underperforming money managers. I still believe they should form the core of most people's investment portfolios, but they are not magic. They cannot transform an overvalued market into a high-return investment. They cannot protect you from lost decades. They cannot guarantee that the past will repeat. In 2026 and beyond, index fund investors face real challenges. Valuations are elevated. Concentration is extreme. The passive investing paradox is creating structural risks. Interest rates have risen. The AI bubble mirrors past manias that ended badly. None of this means you should panic. None of this means you should sell everything, but it does mean you should be thoughtful. It does mean you should understand the risks. It does mean you should have realistic expectations and a plan for various outcomes. The investors who will do best over the next decade are the ones who go in with their eyes open. They will understand that 8 to 10% annual returns are not guaranteed. They will diversify beyond just the S&P 500. They will maintain cash reserves for opportunities. They will match their investments to their time horizons. They will save aggressively to compensate for potentially lower returns. And most importantly, they will have the psychological fortitude to stay the course even when things look bleakest. I am not trying to scare you. I am trying to prepare you, because the worst outcome is not a market crash. The worst outcome is a market crash that you were not prepared for. that causes you to panic and sell at the bottom, that destroys not just your portfolio, but your confidence in investing forever. That is what happened to millions of people after 2000. That is what happened to millions more after 2008. And it does not have to happen to you if you go in with realistic expectations and a solid plan. The next decade may turn out fine. Markets may continue their upward march. The AI revolution may deliver everything it promises. America may continue to dominate the global economy. Valuations may stay elevated forever, defying historical patterns. I hope that happens, I truly do. But hope is not a strategy, and betting everything on the best case scenario is not prudent investing. What I am asking you to do is simple: understand what you own, understand the risks, have a plan, and prepare yourself mentally for outcomes that may not match your expectations. If you do those things, you will be fine no matter what happens. The market may disappoint you, but it will not destroy you. And that is the most important thing. Surviving is more important than thriving. Because if you survive the bad times, you will be around to benefit from the good times. But if you get wiped out, if you give up, if you lose faith in the whole system, you will miss everything that comes after. Index funds can still work for you in 2026 and beyond, but only if you use them wisely with realistic expectations, appropriate diversification, and the mental preparation to stay the course through whatever comes. That is my warning. That is my advice, and I hope you take it seriously. Because the people who understand these risks and prepare for them will do far better than the people who blindly assume the past will repeat. It always has before, until it does not. And being prepared for that possibility is the difference between building wealth and losing it.